That's all it took for America's oil export machine to collapse, shedding 94% of its outbound barrels. From Houston to Singapore, traders were stunned. Tankers sat idle in Corpus Christi. West Texas Intermediate, WTI, crude plunged below the critical $60 mark on April 8th, settling at $59.58, triggering panic across the shale belt. The shockwave had started 2 weeks earlier. On what the White House called Liberation Day, President Trump announced a sweeping 25% secondary tariff on any country buying Venezuelan crude, effective immediately. The message: buy from Caracas, and you'll pay a penalty on U.S. exports. The fallout was immediate. Refinery workers in Louisiana, truckers in Ohio, and retirees dependent on royalty checks were suddenly staring at shrinking incomes they never saw coming. At 9:37 a.m. on April 2, 2025, President Trump signed Executive Order 14,245. Within hours, trade lawyers raised alarms about its vague definition of indirect purchases. Even one blended shipment could trigger penalties for an ally. Energy traders hit the sell button before the ink dried. By April 6th, WTI closed at $60.70. 2 days later, it dipped below $60 in intraday trading, confirming a technical breakdown. CME reported a record-shattering 35.9 million contracts traded daily in April, as hedgers and speculators scrambled to protect themselves. Yet, open interest shrank, a sign that investors weren't betting on a rebound. They were fleeing. Then came the physical shock. According to EIA data, U.S. crude exports plummeted by 637,000 barrels per day, falling to just 3.2 million in a single week. Corpus Christi went eerily quiet. Tankers stopped sailing. Barrels backed up, pushing U.S. inventories up by 2.66 million barrels to 442.3 million, triggering capacity warnings in the Houston Ship Channel. The pain hit the Permian Basin almost instantly. Reuters reported day rates slashed. Crews in Midland were told to stand down. Welders earning 6 figures were laid off. Baker Hughes logged the biggest weekly rig drop in the basin since 2022. Analysts warned, WTI under $60 ruins the economics of drilling new horizontal wells. U.S. output is at risk. The futures curve flipped into steep contango. Good for storage plays, terrible for producers needing cash now. OPEC Plus quickly took advantage, pumping 1.37 million more barrels per day, edging U.S. crude out of Asia and Europe almost overnight. Saudi and Russian cargoes undercut WTI by nearly $2 per barrel in Rotterdam. Ironically, American drivers paid more at the pump. Despite collapsing crude prices, the national gas average rose 10 cents to $3.26 because refiners were forced to chase costlier alternatives like Brazilian Lula or Algerian Saharan blend. 72 hours after the executive order, the U.S. energy superpower story was unraveling. OPEC reclaimed market share. American consumers were left holding the bag. In the week following the shock, WTI couldn't reclaim the $60 line. It floated between $59 and $62. Confidence was bleeding out. Speaking at the Qatar Economic Forum, ConocoPhillips CEO Ryan Lance warned, if prices stay in the low 60s, U.S. shale growth will stall. In the 50s, it'll shrink. That message echoed across financing desks. Conoco's break-even model assumes at least $65 per barrel for new wells. And yet, gasoline prices didn't drop. AA reported $3.26 on April 4th and $3.22 a week later, still higher than January. Refiners said rerouting Texas barrels cost more than importing foreign ones. OPEC Plus kept the pressure on. More barrels, deeper discounts. U.S. traders began storing unsold crude. The EIA reported the largest inventory build since 2022. ICE data showed Q2 futures/options volume hit 219.3 million lots, a 21% jump from the previous record. The contango widened, rewarding those with storage and punishing cash-strapped producers. Then came the layoffs. Chevron filed notices for 200 job cuts in Midland County. Severance barely covered 8 weeks. Local officials warned of mortgage delinquencies within 90 days. Service companies were worse off. Schlumberger cut wireline day rates by 25%. Bank of America card data showed restaurant spending in Midland, Odessa dropped 7% YOY, the steepest fall of any U.S. city. Private equity fled. Upstream oil deal-making plunged 60% YOY in Q2. Goldman Sachs lowered its 2026 WTI forecast to $59. Their warning: WTI below $60 means well returns drop below 8%, far short of the 15% lenders expect. Vista Resources delayed 8 planned wells, telling staff to brace for cuts if prices stayed under $60. Gas prices remained stubborn. AA said the average was $3.17 by April's end, still higher than January. Moody's warned, every 10-cent jump at the pump siphons $1 billion in spending from the economy monthly. Fewer tips, fewer jobs, less overtime. Week 4 closed with cruel symmetry. Oil producers couldn't profit at $60. Drivers paid summer premiums anyway. The result? Higher fuel bills, lower paychecks.
Seging 401.
Then China hit back. Just 48 hours after Trump paused the tariff for 90 days, exempting China, Beijing responded with a 125% tariff on U.S. liquefied natural gas, LNG. 2 U.S. LNG ships rerouted mid-sea. $280 million in revenue lost. LNG prices for July delivery dropped 14% in a single session. Gas-rich producers from the Haynesville to Appalachia took the hit. The EIA still projects 13.4 million barrels/day in 2025, but admits volumes will fall once hedges expire. The IEA cut its forecast by 70,000 barrels/day, directly blaming tariffs. Goldman warns if WTI hits $50, output could retreat to 13.1 million barrels/day by 2026. That scenario now holds a 40% chance. Credit desks are forcing producers to hedge at $60 or higher, erasing any rebound potential. Moody's says every 10 million stranded barrels raise interest risk by 25 basis points. That's a knife in the side for small operators already struggling. By July, optimism had dried up. Brent fell below $63. Futures trading volume plunged 30%. Hedge funds increased WTI short bets by 32% in 3 weeks. In Midland, hotel occupancy dropped 16% in May. Restaurants, retail shops, and county tax revenue all felt the sting. Families who thought the tariff pause meant relief were wrong. Prices stayed high. Paychecks didn't. The truth? Without a lasting diplomatic fix, the American energy boom could turn into a slow-burning recession. The liberation tariff was sold as patriotic. But for months later, it looks like America stabbed its own energy backbone. Idle tankers in Corpus. Rusting rigs in Midland. Drivers paying 30 cents more. Investors watching energy shares tumble. Was this national defense, or just expensive political theater? Tell us what you think. Then hit subscribe because the next domino could fall any moment.